And why Trump is battling back? A single trader, 450 tons of silver, one massive short position. While markets collapsed 16%, he smiled. But then something unprecedented happened. 54 nations, one room, one message to Beijing. The Trump administration just deployed 3 economic weapons simultaneously. And what comes next could reshape the entire precious metals market forever. The question isn't whether this billionaire will win or lose. The question is, what does Washington know that he doesn't? Stay with us. Because what unfolds in the next few minutes will change how you see global commodity warfare. Welcome to Currency Archives AG, where we decode the financial moves that shape nations. Now, if you've been following markets long enough to remember when handshakes meant something, when a man's word in business was his bond, then you know the value of reliable analysis. Do us the honor. Press that subscribe button. We're building something rare here. A community that understands wealth isn't built on hype. It's built on information. And tell us, where in the world are you watching from today? New York? London? Mumbai? Singapore? Drop your city in the comments. Let's see how far this analysis travels. Now, let's examine what's really happening in the silver market. On a quiet trading day in Shanghai, while most investors focused on technology stocks and cryptocurrency volatility, a single position appeared in the Shanghai Futures Exchange reporting system that made veteran traders pause. Billionaire had just established the largest net short position on silver in the exchange's history. $300 million, 30,000 contracts, 450 tons of silver bet against. This wasn't a hedge. This wasn't portfolio rebalancing. This was a calculated, aggressive directional bet that silver prices would fall and fall hard. The position size alone demanded attention, but the identity behind it made the bet legendary. Billionaire built his reputation in 2020 when he executed one of the most profitable gold trades in modern commodity history. While central banks printed currency at unprecedented rates and traditional investors fled to safety, he positioned aggressively long on gold futures. The result? Nearly $3 billion in verified gains. His timing wasn't lucky, it was surgical. Now, 5 years later, he had returned to precious metals markets, but this time he wasn't buying. He was selling massively. The technical structure of his position revealed sophistication. The contracts were distributed across multiple delivery months, suggesting this wasn't a short-term speculation on immediate price movements. The position sizing indicated deep conviction. The execution timing coincided precisely with silver testing multi-year resistance levels near $90 per ounce. Then, the price action confirmed his thesis. Silver declined 16% over the following weeks. His paper gains accumulated rapidly. Market observers calculated his unrealized profits had already reached tens of millions, and the position remained open. But Billionaire's bet represented more than individual speculation. It signaled a broader strategic assessment about global silver markets that contradicted the prevailing narrative among Western precious metals investors. The conventional wisdom in London and New York trading desks held that silver faced a structural supply deficit. Industrial demand from solar panel manufacturing, electric vehicle production, and electronics consumption continued expanding. Mine production struggled to keep pace. Inventories at major exchanges declined steadily. Every fundamental metric suggested higher prices ahead. Yet here stood a trader with a proven track record, betting $300 million that the consensus was wrong. The position raised immediate questions among market analysts. What did Billionaire see that others missed? Had he identified a demand collapse in Chinese manufacturing? Did he possess advanced information about new mine production coming online? Was he hedging physical silver holdings elsewhere in his portfolio? Or did his bet reflect something larger, something connected to geopolitical strategy rather than simple supply-demand calculations? The Shanghai Futures Exchange operates within a unique regulatory framework. Chinese authorities maintain capital controls that create price differentials between domestic and international markets. Shanghai silver prices typically trade at a premium to London and New York spot prices, reflecting restricted arbitrage opportunities and strong domestic demand. But Billionaire's short position occurred as these premiums began compressing. Shanghai futures prices, which had traded as high as $99 per ounce, started declining while Western spot markets held relatively steady around $70. The premium that previously exceeded $11 per ounce narrowed significantly. This price structure suggested something was changing in Chinese silver demand, or Chinese access to Western silver supplies, or both. The timing of Billionaire's position also coincided with broader commodity market volatility. Equity markets experienced sharp corrections. Cryptocurrency valuations declined precipitously. Even gold, traditionally viewed as the ultimate safe haven, struggled to maintain momentum above $4,800 per ounce. Risk assets across all categories faced simultaneous selling pressure. Yet Billionaire had specifically targeted silver, not broader commodities, not general market shorts, silver. The specificity of his bet indicated targeted conviction based on particular analysis of silver market dynamics rather than general bearish sentiment. Market participants monitoring the position recognized that $300 million represented just the notional value at current prices. The actual capital required to establish and maintain the position through margin requirements would be substantially less, meaning Bianying's effective leverage amplified both his profit potential and his risk exposure. If silver prices reversed and rallied, the losses could accumulate rapidly. The position size meant he couldn't exit quietly. Any attempt to cover the short would itself move markets. He had committed to this trade with no easy escape. But as Bianying's position registered in market data systems, another development was unfolding simultaneously, 8,000 miles away in Washington. The United States government was convening the largest gathering of resource-producing nations in recent history, and their agenda centered on one topic: critical minerals. The invitations went out quietly. No press releases, no advance publicity, no diplomatic fanfare that typically accompanies international economic summits. 54 nations received a simple message from Washington: attend a ministerial meeting on critical minerals supply chains. The date was set, the location classified until 48 hours before commencement. The attendee list: representatives controlling approximately 2/3 of global economic output. This wasn't a United Nations assembly. This wasn't a G20 gathering. This wasn't a World Economic Forum discussion panel where officials delivered prepared remarks and posed for photographs. This was something different entirely. Vice President J.D. Vance and Secretary of State Marco Rubio would personally host the proceedings. Not deputies, not undersecretaries, not special envoys. The second and third most powerful officials in the American government were dedicating their time to a meeting about minerals. The signal was unmistakable. When a vice president who typically focuses on domestic policy architecture and a secretary of state managing global diplomatic crises both clear their schedules simultaneously for a commodities discussion, the subject matter transcends routine economic coordination. The meeting occurred behind closed doors in a government facility designed for classified briefings. Standard diplomatic protocol was abandoned. No joint communiques were prepared in advance. No agreed-upon talking points were distributed to participating delegations. The format resembled a strategic briefing more than a diplomatic conference. Inside the secured facility, J.D. Vance opened the proceedings with a statement that reframed the entire discussion. He acknowledged that global attention had become fixated on artificial intelligence, quantum computing, and digital currencies. The business press celebrated technology billionaires and software innovations. Investment capital flowed relentlessly toward Silicon Valley and its international equivalents. But beneath the digital economy, beneath the cloud computing infrastructure and the cryptocurrency networks and the autonomous vehicle systems, lay an inescapable physical reality. Every technology requires physical materials. Every server farm requires copper. Every electric vehicle requires lithium. Every solar panel requires silver. Every semiconductor requires dozens of rare earth elements. The digital revolution depended entirely on ancient geological processes that concentrated specific elements into miniable deposits over millions of years. Vance's message was direct. The assembled nations represented the majority of these deposits. They controlled access to the raw materials that powered modern civilization. And that control had become fragmented, vulnerable, and strategically exploited. He used a term that made several delegates lean forward in their seats: greater independence and self-reliance in critical minerals. In diplomatic language, this phrase carried specific meaning. Independence from whom? Self-reliance against what threat? The unspoken answer filled the room: China. Beijing had spent 2 decades executing a methodical strategy to dominate global supply chains for strategic materials. Through state-backed mining companies, favorable loan terms to resource-producing nations, and vertical integration of processing facilities, China had positioned itself as the indispensable intermediary in critical minerals markets. Rare earth processing, 90% controlled by Chinese facilities. Lithium refining, 70% Chinese capacity. Cobalt processing, 75%. Even materials mined in Australia, Africa, and South America typically passed through Chinese processing infrastructure before reaching Western manufacturers. The strategic vulnerability was profound. A single decision in Beijing could disrupt supply chains for industries representing trillions in economic value. The Trump administration had identified this dependency as a national security threat, requiring immediate multilateral response. But critical minerals represented a broad category encompassing dozens of elements. The meeting could have focused on lithium for batteries. It could have emphasized rare earths for defense applications. It could have highlighted cobalt for industrial processes. Instead, Marco Rubio's presentation centered on a specific subset of materials where Chinese market positioning had become particularly aggressive. He displayed pricing data on screens throughout the briefing room. Silver appeared prominently. London spot price, $70 per ounce. Shanghai spot price, $81. Shanghai futures price, $99. The premium Chinese buyers paid over Western markets $11 per ounce. These weren't minor discrepancies. These were structural price dislocations indicating restricted supply access and captive demand. Rubio explained the industrial significance. Silver's unique properties made it irreplaceable in solar panel manufacturing, 5G infrastructure, and advanced electronics. Chinese industries consumed approximately half of global annual silver production. As China expanded renewable energy deployment and electronics manufacturing, that consumption was projected to increase substantially. The price premiums Chinese buyers paid revealed their desperation to secure supply. But here was the strategic opportunity. Western nations controlled significant silver mining production and held substantial inventories in exchange warehouses. If coordinated properly, these resources could be leveraged to achieve multiple objectives simultaneously. The assembled ministers received a classified briefing document outlining a 3-component strategy. The details remained confidential, but the framework became clear through subsequent policy actions. Pricing mechanisms would be restructured, production incentives would be deployed, access controls would be implemented. The Trump administration wasn't proposing sanctions that would violate international trade frameworks and invite retaliation. Instead, they were suggesting a coordinated approach that used market mechanisms to achieve strategic outcomes. As the ministerial meeting concluded, participants departed without public statements. No photographs were released, no official summaries were published, but within 72 hours, policy changes began appearing in participating nations. And 8,000 miles away, Bianying's short position suddenly looked either brilliantly prescient or catastrophically exposed. 3 mechanisms deployed simultaneously create something economists rarely witness in modern markets. Coordinated intervention without formal announcement, strategic pressure without explicit policy, market manipulation that operates entirely within legal frameworks. What emerged from that closed-door ministerial meeting wasn't a treaty. It wasn't a trade agreement. It wasn't even a memorandum of understanding requiring legislative approval. It was something far more sophisticated. The first weapon appeared in pricing architecture itself. Silver markets operate across multiple exchanges with different regulatory structures, participant bases, and settlement mechanisms. Under normal conditions, arbitrage keeps these markets aligned. When London prices diverge from New York prices, traders immediately exploit the differential until equilibrium returns. But the Shanghai Futures Exchange exists behind China's capital controls. Moving money into China remains relatively straightforward. Moving money out requires government approval. This asymmetry creates persistent price premiums for commodities trading in Shanghai versus Western exchanges. For years, this premium remained stable around 3 to 5%. Chinese buyers accepted the markup as the cost of accessing global commodity supplies within their controlled financial system. Then something changed. Western spot silver, $70 per ounce. Shanghai spot silver, $81 per ounce. Shanghai futures silver, $99 per ounce. The premium had exploded to 15%, then 20%, then 41% for futures contracts. This wasn't normal market behavior. This was supply restriction manifesting in price. The Trump administration hadn't imposed sanctions. They hadn't banned silver exports to China. They had done something more subtle and more effective. They had convinced Western mining companies and trading houses to delay deliveries into Chinese markets. Not cancel them, delay them. Invoke force majeure clauses, cite logistics complications, reference quality control procedures requiring additional testing. Each delay was defensible, each postponement had legitimate business justification, but collectively, they created systematic supply tightness in Chinese markets, while Western inventories remained adequate. The price differential widened. Chinese industrial consumers faced a choice: pay the premium or halt production. Solar panel manufacturers couldn't wait. Electronics producers couldn't substitute alternative materials. They paid. Meanwhile, Bianying's short position was structured in Shanghai futures contracts. As the premium expanded, his position moved underwater. The 16% decline in Western silver prices meant nothing if Shanghai futures held elevated levels. His $300 million bet was bleeding. The second weapon targeted production economics. Silver mining operates on thin margins. At $70 per ounce, many deposits remain uneconomic. The capital investment required to open new mines or expand existing operations does not justify the risk when prices hover near production costs. But at $99 per ounce in Chinese markets, suddenly those calculations changed dramatically. The ministerial meeting included representatives from Peru, Mexico, Australia, and Chile, nations controlling the majority of global silver mine production. Within weeks of the Washington gathering, mining companies in these countries announced expanded capital expenditure programs. New feasibility studies were commissioned, mothballed mines received fresh investment, processing capacity expansions were approved. Each project cited favorable long-term price outlooks as justification. The message to Beijing was clear. If China wanted to secure silver supplies through premium pricing, Western producers would respond by increasing output. But that output would flow through Western-controlled supply chains with Western-controlled delivery schedules. The supply expansion wouldn't arrive immediately. Mine development requires years, but the announcement of increased future supply applies immediate downward pressure on forward prices. Futures markets reflect expectations. When market participants see credible supply increases coming, they sell futures contracts, driving prices lower. Bianying's short position had been established precisely to profit from falling prices. But he had positioned in Shanghai markets, where premiums were expanding even as Western prices declined. He was right about direction, but wrong about geography. The third weapon was the most aggressive: access restriction, not through sanctions, not through export controls, through something far more nuanced. London Metal Exchange warehouses hold substantial physical silver inventories available for delivery against futures contracts. These inventories operate under specific regulatory frameworks requiring transparency about quantities and locations. But warehouse operators maintain discretion about which entities can access metal for physical delivery. Following the ministerial meeting, major Western trading houses quietly updated their counterparty approval procedures. Chinese entities seeking to take physical delivery from LME warehouses suddenly faced enhanced documentation requirements. Additional financial guarantees were requested. Settlement timeframes were extended. Again, each requirement had legitimate compliance justification: anti-money laundering regulations, know your customer protocols, sanction screening procedures. But collectively, they created friction in Chinese access to Western physical metal supplies. The premium between paper prices and physical metal availability widened further. Chinese buyers couldn't simply purchase futures contracts in London and take delivery in Western warehouses. The metal was theoretically available, but practically inaccessible. This forced Chinese silver consumers to rely increasingly on domestic inventories and Shanghai exchange supplies, precisely where Bianying had established his massive short position. The three mechanisms worked synergistically. Delayed deliveries created artificial scarcity in Chinese markets. Production announcements pressured forward curves. Access restrictions prevented arbitrage that would normally equalize prices. Bianying found himself trapped in a position where Western markets confirmed his bearish thesis, while Eastern markets moved against him. His sophisticated analysis of global supply-demand fundamentals was correct. His timing of the trade was excellent. His risk management was professional. But he hadn't anticipated coordinated state-level intervention designed specifically to create the exact market dislocation that would destroy his position. The invisible hand of free markets had become a fist, and that fist was squeezing. But markets are complex adaptive systems. They resist manipulation. They find equilibrium through unexpected channels. What Washington hadn't fully calculated was how Beijing would respond, and whether Bianying's $3 billion track record reflected luck, or an understanding of Chinese government strategy that Western analysts consistently underestimated. Markets reveal truth through price, not through press releases, not through government announcements, not through analyst projections, through price. And in the weeks following the ministerial meeting, price began telling a story that neither Washington nor Bianying had fully anticipated. The carefully constructed three-weapon strategy had created the intended pressure. Shanghai premiums remained elevated. Western supply chains tightened their delivery schedules. Mining companies announced expansion plans. Chinese industrial consumers paid premium prices for silver access. Everything was proceeding according to the strategic framework. Then equity markets collapsed. The S&P 500 declined 8% in 11 trading days. The Nasdaq dropped 12%. Technology stocks that had carried valuations justified only by perpetual growth assumptions suddenly faced margin calls and forced liquidation. Cryptocurrency markets, which had positioned themselves as alternative stores of value, fell even harder. Bitcoin declined 23%. Ethereum dropped 31%. The entire digital asset complex experienced simultaneous selling pressure. Gold, the traditional safe haven that typically rises when risk assets fall, managed only marginal gains before stalling near $4,800 per ounce. And silver fell across all markets simultaneously. Western spot markets dropped from $70 to $62. Shanghai spot declined from 81 to 74. Even Shanghai futures, which had held elevated premiums, fell from 99 to 87. The coordinated intervention strategy had created artificial price dislocations, but broader macroeconomic forces overwhelmed the manipulation. When leveraged positions across all asset classes face margin calls simultaneously, investors sell what they can, not what they want to. Hedge funds holding silver as portfolio diversification liquidated positions to cover losses in equity portfolios. Commodity trading advisors running systematic trend-following strategies received sell signals across precious metals. Chinese manufacturers facing tightening credit conditions reduced inventory purchases. The selling pressure was indiscriminate and overwhelming. Ying's short position, which had been underwater due to Shanghai premium expansion, suddenly moved dramatically profitable as absolute price levels collapsed across all markets. His 16% decline assumption had been conservative. The actual decline exceeded 20% in some contracts. His paper gains approached $100 million. But here was the complexity that separated sophisticated traders from amateurs. Ying didn't celebrate. He didn't close the position to lock in profits. He didn't issue public statements claiming vindication. He doubled the position. Reports emerged from Shanghai Futures Exchange showing additional short contracts registered under entities connected to his trading operation. The position that had represented 30,000 contracts grew to 47,000 contracts, $600 million notional exposure, 700 tons of silver bet against. This wasn't profit-taking. This was conviction scaling. The move revealed something crucial. Ying's original thesis hadn't been based on technical chart analysis or short-term price momentum. He had positioned based on fundamental understanding of Chinese government industrial policy. And that policy was about to become explicit. Beijing's response to the Western ministerial coordination didn't come through diplomatic channels. It came through industrial directives. Chinese solar panel manufacturers received government guidance to reduce silver content per panel through alternative metallization techniques. The technology had existed for years but hadn't been economically justified. Now it received state subsidies and mandated implementation timelines. Electronics manufacturers were directed to prioritize copper-based alternatives in circuit board production where technically feasible. Again, subsidies made the substitution economically viable. State-owned trading companies were instructed to draw down physical silver inventories and shift procurement toward other industrial metals with less geopolitical supply risk. The message was clear. If Western nations wanted to use silver supply as economic leverage, China would simply reduce its dependence on silver. The demand destruction wasn't immediate. Industrial processes don't change overnight. But the policy direction was unmistakable, and the long-term implications were devastating for silver prices. Ying had understood this policy response before it was announced. His initial short position anticipated Western supply tightening would trigger Chinese demand reduction. His position expansion occurred precisely as policy directives confirmed his thesis. The Trump administration's three-weapon strategy had achieved tactical success. They had created price dislocations. They had pressured Chinese industrial consumers. They had demonstrated coordination capability among resource-producing nations. But they had triggered a strategic response that undermined the entire precious metals market structure. When the world's largest silver consumer announces systematic demand reduction, the impact on long-term price equilibrium is catastrophic. Mining companies that had announced expansion plans suddenly faced questions about project viability. Western investors, holding physical silver as inflation hedges, watched Chinese policy eliminate a major source of industrial demand. The very mechanism designed to pressure China had created conditions that validated Ying's bearish thesis. This was the fundamental miscalculation in Washington's approach. They had treated commodity markets as tools for geopolitical leverage without fully accounting for how their largest customer would respond to being leveraged. Markets don't respond predictably to intervention. Coordination among 54 nations sounds impressive until a single nation controlling half of global demand changes its consumption patterns. The current state revealed itself in stark numbers. Western silver spot, $58 per ounce and declining. Shanghai premium, compressed to $4. Ying's position, profitable and expanding. Mining company expansion plans, under review. Chinese silver imports, down 37% year over year. The strategic outcome was emerging clearly. Washington had won the battle for supply chain coordination. Beijing had won the war for demand control. And Ying, the silent trader who had bet $300 million against conventional wisdom, was positioned to profit from both sides destroying each other's strategies. But commodity markets operate on geological timeframes measured in decades, not political timeframes measured in election cycles. The ministerial meeting represented one moment. Chinese policy directives represented another moment. The actual resolution would unfold over years as mines either opened or closed, as industrial processes either adapted or failed, as prices either stabilized or collapsed. What remained undeniable was that a single trader had identified the strategic dynamics before governments had fully wargamed the consequences of their interventions. Ying's $3 billion gold trade hadn't been luck. His $600 million silver position wasn't speculation. It was pattern recognition applied to the intersection of markets and state power. The question facing investors, industrial consumers, and policymakers wasn't whether Ying would profit. The question was whether anyone understood silver markets well enough to know what happens next. When governments realize their weapons have backfired,